If you were somebody that was holding out for lower rates before you decided to take the plunge on home ownership, I've got some news that might not make you very happy, and it relates to the cost of getting a home loan. Recently, we heard from the Federal Housing Agency that they are making changes to the loan level price adjustments for mortgages, which will mean that a lot of Americans are going to be paying higher rates or larger costs when they go to close on their home loan. But I'm going to be doing my best to break it down for you in this video. And if you are new here, my name is Lizy Hoeffer. I am a residential loan officer out of Phoenix, Arizona, and I've worked in mortgages since 2002. And I hope that this channel provides you with tactical money tips to help you make smart home purchases. So in order to properly explain this, I have to get a little bit mortgage nerdy on you. So I hope I don't go too far, but I want to explain what a loan level price adjustment is. Essentially what it is an increased risk factor to your loan that makes the price of what they're willing to charge for an interest rate either higher or lower. Each interest rate that we provide to you either comes at a cost, comes with a credit, or is at what we call par, which means no cost or credit. And a loan level price adjustment will make an interest rate more expensive or require us to raise the rate to cover the cost, or it will make it less expensive, which means that we can bring the rate down. Oftentimes, what changes in interest rates from bank to bank, we all have the same loan level price adjustments, but what changes bank to bank is the additional margins that we include in the pricing. And so this will vary from bank to bank depending on that, but the loan level price adjustments are constant for anyone who is providing a conventional loan in the United States. Just to be specific, these loan level price adjustments only impact conventional loans. So these are the loans that are insured by Fannie Mae and Freddie Mac. This is not a jumbo loan or a FHA, VA, USDA. These changes do not impact that type of financing. But since a lot of consumers, especially first-time homebuyers, use conventional financing, it's an important thing to talk about because it's going to impact a lot of people. Now, conventional loans vary in loan amounts, and you will have to look up what yours is for your area. But here in Phoenix and Maricopa County, the maximum conventional loan limit is $726,200. And the reason that this is important is because it extends a very large percentage of all the houses that we have available, and you can get a 3% down payment as a first-time home buyer, right? So it really makes housing more affordable for a larger percentage of buyers. And so what's unfortunate about these changes is that they have, basically flattened out the curve for higher FICO borrowers and lower FICO borrowers, but they've made it more expensive for people with higher credit scores to buy houses, and they've made it more affordable for people with like a 680 FICO score with lower down payments. And one of the other big significant changes to these loan level price adjustments has to do with debt to income ratio. This was always something that as a loan officer perplexed me that there wasn't one that already existed, but essentially the higher your debt payments are, including your house payment to your gross income, the higher risk you have of defaulting on that loan. And so it only makes sense that they include a risk adjustment for this. And I'm surprised, honestly, that there wasn't one that existed. And part of the reason that I believe that is the case is because oftentimes debt to income ratio isn't a true reflection of a household income. Oftentimes we can include borrowers that have maybe lower credit scores or maybe have income documentation that's difficult to verify per the guidelines. They don't have consistent bonuses or commissions, or they just started a business. And so it's hard sometimes for debt to income ratio to truly be reflected in somebody's loan application, but this is a new pricing adjustment that will impact some borrowers. And again, it is just something else to consider when you are buying, right? To make sure that you are buying in an appropriate budget. Now, I want to do some speculation, which means this is just my opinion, on why they just rolled these out right now. And there has been a lot of talk about a huge refinance boom around the corner because we are seeing interest rates drop. We saw a pretty significant drop already this year. And as an industry, that's really scary because our interest rates are backed by these things called mortgage-backed securities, which are just pooled loans. So they take a bunch of 30-year fixed mortgages and then they sell off the servicing, which means the returns on the payments, to investors to free up liquidity to then keep loaning. And the thing is that when those mortgages are, paid off in under a 3-year period of time, the bank actually loses money. And so it's so important that they kind of taper off, this huge wave. And so I think that a lot of these loan level price adjustments are coming out of those fears, right, of this huge refinance wave. Now, obviously, none of us are clairvoyant. I don't even know what interest rates will look like, but these changes are said to be made effective on any loan that's insured on May 1st. So depending on the lender, we might see these changes, enforced as soon as February. I'm assuming that it'll probably take place for loans, closing in March to mid-April, but it is something that is taking place right away. So if you are someone that has been wanting to get their home loan priced out and maybe has like a 720 or a 740 FICO score, now might be your opportunity to maximize your best rate potential. If you guys have any questions with any of the information that I provided on today's video, please know that you can always reach out to me in an email or call my team line. You can reach out to me on IG, or you can shoot them in the comments below. I really love hearing from you. And if you found today's video helpful, I hope you'll remember my team the next time you need a home loan and share this video with a friend or family member that could use these helpful tips.